Ship Show, the morning brief. I'm Brad Smith alongside Madison Mills this morning. Let's get to the three things that you need to know today.
First up, U.S. stocks stalling in today's trade after the S&P 500 reached an all-time high in Tuesday's session. That was driven by a rally in the chip makers. Meantime, Meta's record 20-day run finally coming to an end after the social platform added more than $320 billion to the company's market value.
Plus, investors are grappling with Trump's latest plans to impose tariffs on about 25% on cars, semiconductors, and medicine imports, with an announcement coming as soon as April 2nd in a move that would represent a widening of his trade war. Now, Trump has previously announced 25% tariffs on steel and aluminum that are set to take effect in March. His latest comments are his most detailed yet in specifying other sectors to be hit with levies.
And traders' attention also focused on Federal Reserve meeting minutes, which could offer clues on the monetary policy outlook. Several officials, including Governor Christopher Waller and San Francisco Fed Chief Mary Daly, have signaled rates will stay on hold until inflation slows significantly.
The U.S. stock rally fading today as President Donald Trump threatens 25% tariffs on foreign cars, semiconductors, and pharmaceuticals. This as the 10% additional tariff on China is in effect, and tariffs on steel and aluminum are expected to take effect mid-March. We're taking a look at futures here this morning. They are down across the board for the Dow, the S&P 500, and the Nasdaq. Fractionally as they may be, there's a few things, of course, to take away with some of the latest announcement and the details that are starting to be clarified around what would be additive here and the industries specifically that would be impacted here. And you think back to what Jim Farley had said, who was the Ford CEO, just a few days ago, talking at an investor conference about a week ago, saying a 25% on Mexico, Canada would, quote, blow a hole in the U.S. industry we have never seen here. Worth noting as well that Ford was one of the companies that actually donated to the inauguration fund for President Trump as well. They had anticipated that there would be tough tariff talk, but the extent of which unknown at that time, now being a little bit more clarified.
Yeah, it's interesting, particularly that we are seeing this kind of ratcheting up of tariffs. And if we pull up that calendar again, you can see, as a reminder, we already have that 10% tariff on China, proposed tariffs on Mexico and Canada set to go into effect early March. As a reminder, that was delayed by a month after negotiations between the U.S. and Canada and Mexico. They got a little bit of a reprieve with a month there. We also have steel and aluminum coming up. If we can pull up that full screen there, you'll be able to see that. Having said that, it is interesting that the market continues to kind of slough off any potential tariffs here. And again, you can see that 25% tariff on steel and aluminum, cars, drugs, and chips. That sector in particular in focus because that is the news from this week. Trump talking specifically about tariffs to come on those sectors. But again, the market's sloughing that off. We're not seeing a huge sell-off in those car names, in pharmaceuticals, and certainly not in chips, which drove the S&P to another all-time high yesterday. So is the market saying that Trump is just using tariffs as a negotiating tactic, or is the market missing something that could be more sinister? And that is the key question for investors moving forward.
Yeah, I was looking at a note from Macquarie yesterday, and they said despite uncertainties surrounding some of the new immigration tariff policies, they actually believe that there's more favorable environment for other areas of the market that they're looking at here. So it does speak to your point of how much some of the biggest asset managers and money managers out there are saying until there is a more widespread or even long-standing impact, and that would take us into the conversation around how long are the tariffs actually staying on the table until a negotiation is actually coming to fruition. That is something that could have a larger GDP impact, and until they see that GDP impact, it's unlikely that we would see a major revision from some of the largest money managers out there, as we were mentioning a moment ago. But in terms of some of the GDP impact, I was looking at the Tax Foundation and some of the analysis that they were running. Even prior to the latest tariffs that were announced, they were already anticipating that there would be a potential net negative headwind to GDP of about 0.3% here with the tariffs that were already talked about and those that are still on the table from the first Trump administration. flowed through the Biden administration and are still something that industries are having to navigate through.
And that's significant given that one of the three tenets of Treasury Secretary Scott Bessent's approach to tariffs is driving growth stateside, is this idea that tariffs will lead to more U.S. production, but estimates from the Tax Foundation indicating that GDP will be put under pressure due to these tariffs. So a question remaining about which of those two is going to come to fruition and where the priorities will lie after negotiations, where things will kind of net out. But let's turn now to the impact of potential tariffs on the chip sector. President Donald Trump threatening those levies of 25% or more on semiconductor imports. So joining us now with more on this, we've got Maribel Lopez, the founder of Lopez Research. Maribel, it's great to have you on here. I want to talk specifically about the impact of these tariffs on some of these chips names in particular that drove the market to all-time highs early this week. Is the market missing something sinister when it comes to tariffs, or is the market right to kind of be sloughing off any potential negative impact?
This is really an opening volley by Trump to say he's really serious about tariffs. Tariffs will happen. The amount of the tariff and what the negotiation standpoint is still unknown. So this is like, hey, I'm throwing it out there. You're going to come to me. We're going to have a negotiation. And we're going to try to figure out how you are going to invest more in America. And that's really what I see as the statement that Trump is making here. This is why we're looking at April and not tomorrow. If we're looking at April, there's plenty of time for someone like TSMC to call and say, hey, here's how we're feeling about investing more in foundries in the US as an example. Same for Samsung and other companies that already build chips here, but not at a very significant standpoint.
Are there industries that you think are more likely to be successful making sure that they're included in an exemptions or an exclusions list as they try to vie for the ear and the mind of the president?
So some companies actually already have a strong foothold. You mentioned the automotive industry. If you look at somebody like BMW, they already manufacture a significant portion of what they sell in the U.S., upwards of about 50% in the U.S. So they actually have a better negotiating ability than, say, Samsung, who does manufacture some goods here, such as some of their home products, but not necessarily enough. So we're seeing that it is wildly unevenly distributed across the various companies and across the various sectors. But I think the call to action for everybody right now is to try to figure out what they can do to make a play to say that they're going to invest in America to either create manufacturing jobs, to create investment in some other type of category that we would consider as beneficial to the economy. And this is why the fund managers are not overreacting to the statement at this point, because they understand at this moment, it's still a negotiation.
So it sounds like you think the market is right to view this as that negotiation, not as something more serious. But do you think that the Trump administration is kind of angling towards universal tariffs by throwing out these larger numbers like a 25% to kick off those negotiations? And could there be risk associated with that?
I think they're incredibly serious about tariffs across the board. I think this is definitely a statement that says no industry, no country will remain unscathed by tariffs, and that you have to have a plan on how to work with us. We are serious about rebalancing, whatever they think rebalancing means, but they have definitely indicated that they are serious about it. So the real thing to watch here, to your earlier point, is when do they come in effect? How long do we expect them to be in effect? And what would be considered a sufficient and necessary investment in the US? But clearly, there are many companies that are looking at this saying, if you're a auto manufacturer, say in Japan, if you are a semiconductor manufacturer in Taiwan, you're looking at what could this do to my profitability? How do I find a way to make sure that there's a sufficient investment that we don't end up with a 25% tariff, which is a significant number for any company's.
Maribel, almost a two-part question here. Number one, as you think about the companies that are kind of bracing for this and trying to figure out how to navigate around it, what does that mean in the near term for their innovation pipeline? Do they become a little bit more wary about how they can generate some of these cross-border business opportunities at the same time as they're making sure that they're investing further in an R&D pipeline? And then I guess on the other side of this, as they're thinking about their relations in other countries, how do they also need to strike a balance of saying, okay, yes, we agree with you, President Trump, but also going to other administrations elsewhere around the world where they're trying to operate and say, hey, we're hoping that you net out a good deal here too, as we're trying to operate in your region?
So I don't think this was unexpected. I think the issue, if you look in the semiconductor space, there's a tremendous amount of innovation that is not related to the actual manufacturing, which is really what, say companies like AMD and Qualcomm sell. And they're looking at companies like TSMC for manufacturing. Now the question is, how do we think about redistributing that? And is there a path where we can say we're not going to disrupt how we actually manufacture, and we can still manage to migrate this forward into keeping the innovations that we're really good at, but leveraging the global economy? This, I think, is actually a very tricky balance. So we're looking closely at how fast, for example, you can build a foundry. Even if you wanted to move all your manufacturing to the US today, it is physically impossible. So there has to be some kind of negotiation on a global scale of where and how and what the timeline looks like. And so we've had the opening volley to say negotiations start now. We need to get a plan between now and April to make that happen.
Which specific chips names are insulated from the risks of those potential export controls and the tit for tat over tariffs, in your view?
Honestly, I don't see any chip company or any type of company at this point being fully insulated from a risk at this moment. This is one of these moments in history where you look back and you say, I need to make a plan.
Yeah, so that in mind, how are we thinking about the potential impacts to gross production as well here in the U.S.? If we're talking about where some of these chip companies would anticipate they'll be able to generate purchase orders elsewhere around the world and then ship those chips, does that also institute some type of, or at least elicit some type of GDP impact from your evaluation?
So one of the things that we are concerned with is on a global scale, if we impose tariffs, what kind of tariffs do we see on the other side? So there actually is global risk for how much product gets sold outside of the US, not just the consequences of inside the US. So we do foresee that there could be some slight stall. Now, I don't think that this is a long-standing thing. I'm firmly of the belief that this is still in negotiation play standard, but you have to be running scenarios that say, on the global standpoint, do I expect, for example, there to be a 10 or 20% decrease in China? Do I expect there to be a decrease in the European landscape? So that is actually on the table. So right now, everybody's sitting with their Excel spreadsheets, running numbers, trying to figure out how they make this happen, trying to actually figure out what should be their ask. I imagine it's going to be very busy at the White House between the whole global landscape and all of the US-based companies going to the White House trying to make a play for what they think is the right move. So these are the times when strategy is going to be created. There will be winners, there will be losers, but we absolutely think that there's going to be a shift in the dynamic of both how we see manufacturing happening, how we see the job landscape.
Let's talk about NVIDIA, because we're gearing up for NVIDIA earnings here. And it's going to be interesting to look at the market reaction, because there's this question of risk and whether the bigger risk is in AI earnings disappointing or in DeepSeek proving out their efficiency further. Which of those two do you think has the bigger potential risk for a company like NVIDIA?
If you look at a company like NVIDIA, they can actually sell every chip that they produce right now. The real risk upside for them is, can they produce enough to overperform what the market's expecting of them? The market has had incredibly high expectations for NVIDIA every single quarter. They have blown it out of the park. At some point, we just see a stall, not even because of what NVIDIA builds or because what's built in the landscape, but because of just the ability to assume these chips, build the data centers, have the AI services up and running. So I think we're headed for a disappointment on the AI landscape on multiple fronts. One of them just being sheer data center capacity, energy utilization, buyers buying actual AI services. There's a lag between building and buying, and we have not crossed that chasm at this point.
Maribel Lopez. Maribel, thanks so much for taking the time here this morning. Appreciate it.
Thank you.
Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street in a little bit. Plus, we've got a look at Nikola as the embattled EV maker files for bankruptcy. And we check in on Occidental as the company falls after earnings. How does Warren Buffett feel about them? We'll discuss that much more on Morning Brief. Stock futures taking a breather after the S&P 500 hit a fresh record high on Tuesday. Our next guest believes the AI story is still intact in tech, making it his most preferred sector within equities. Joining us now, we've got Jason Draco, who is the UBS Global Wealth Management Head of Asset Allocation. Jason, great to have you here in studio with us.
Great to be here.
So talk us through that positioning that you're identifying right now within tech.
So obviously DeepSeek was sort of disrupted some of the thesis overall for the tech story. But as we kind of step back and look at, I think, the big picture of like what that model entailed, one, it seems like it's really consistent with the developments in these large language models. It looked like it was a game changer, but when you look at kind of the arc of the development of these models, it's still kind of consistent with improvement, lower costs. That wasn't ultimately maybe the bigger game changer. And what we also saw coming out of the earnings season is that the big mega cap companies actually ramped up their CapEx spend. They know what's going on. It wasn't like this kind of caught them necessarily off guard. Yet despite that, they kind of ramped up their CapEx spending. So we're seeing a big increase this year in CapEx spending. The thesis is still very much in play. Maybe the winners and losers shake out a little bit, but the overall thesis, I think, is still on track.
So the AI-driven momentum rally, still on track in your view, but it seems like there's been this kind of rotation under the hood of the S&P. Yes, we're still getting all-time highs, but you're seeing financials contributing more frequently to that. Does that mean that there is a risk to some of those big tech names that's maybe not being fully appreciated by the market, because why not keep riding the momentum?
So I think like we've seen in the past year and a half, periods of time, a couple of weeks, a couple of months, where the market's rotated, you saw small caps do well. You're seeing European equities do well. Those have been underowned when it's sort of sometimes the momentum goes that way, you got investors kind of chase it, but it's never really been sustained. And so I think one, you need the macro conditions to be very favorable for the sustained rotation towards value stocks, cyclicals, financials like that. So I think that could happen, but every time there's a bit of a hiccup, the tech stocks, these kind of mega cap names, are the ones that sort of investors kind of go back to. I think that will continue to play out, and unless there's a real disruption in the earnings story. And thus far, we expect some moderation of earnings growth from incredibly high levels to still really good levels. So I think the thesis hasn't changed. So right now, it's a little bit of kind of position in the markets, a little bit of rotation, more so than a fundamental change in the overall story for either AI or the macro story in general.
It seemed like at the beginning of the year, S&P 500 earnings growth forecasts were largely in consensus at about 15%. Do you expect us to come down dramatically from that level, and if so, where?
Well, if you're talking about 2025, it depends also whether it's bottoms up or top down. I think the bottoms up analysts tend to be a little bit more optimistic, and those get kind of revised lower. Top down, we were at 9%. Based off of the earnings we can see for 4Q, when we're about 80% way done the season, might be a little bit higher than our expectation. So it just sort of shifts the level higher, but our expectation for the S&P this year is 270 per share for the overall index. That implies about an 8 or 9% earnings. Now the guidance we've got from companies for this year has actually been sort of coming down a little bit faster than typical. I mean, typically, companies kind of guide lower than they beat. We know how the game works. It's been a little bit more
sandbagging out there.
A little bit, setting the bar at a level they can kind of clear, right, comfortably. So that bar has been a little bit lowered a little bit more, but overall the story still looks kind of relatively positive for the earnings. So it just depends on kind of where your starting point is. We're still seeing close to double-digit type of earnings growth this year. Nothing in the guidance thus far suggests otherwise.
But it does seem like there's still a bit of disappointment from investors when that guidance doesn't come in and show continued record-breaking earnings growth. Are any dips off of earnings, let's say Nvidia, for example, if they disappoint on guidance and there's a dip in the stock, is that always viable in your view for the big tech names?
Well, it has been viable. If you just look at what's been happening this far this year, retail investment flows and buying has been very, very strong for the first 6 weeks of the year. We saw it also in the tech space that when there was those pullbacks in Nvidia, retail investors in particular were buying. So I think there's a buy the dip mentality. These stocks have done so well. I think a lot of people feel, if they didn't get in before, if there's a pullback of 15, 20%, that's a chance to kind of re-engage. So until there's a real crack or, significant crack in the thesis, I think those dips will be bought, not only in the mega cap names, but frankly, equities overall. I think that until those people really believe the economy could roll over in some way, then any sort of pullback is great. Now valuations get a little more attractive and we'll put money to work. So I kind of think of it as there's an investor put in the markets. Anything that's, say for the S&P, like around 5,700 in that range, I think you actually get a significant amount of buying and sort of resistance unless things look like they're really deteriorating in some way.
What about within fixed income? What is the pass-through there as you're hearing from Trump administration that's banging the table about lower interest rates?
Well, it was interesting. About 2 weeks ago, Scott Bessent, Treasury Secretary, came out and said, when Trump is talking about interest rates, he doesn't mean the Fed, he means the 10-year Treasury, which is kind of, I have this idea of there's an other Trump put, not just for equities, but for Treasuries, which means you don't want rates to go too high, so you have have to have essentially kind of a floor on the price of treasury bonds, therefore a cap on interest rates. To have that, you basically can't have policy that's too inflationary. So in some way, it's sort of like, I think the bond.
It's difficult when you're also rolling out tariffs at the same time.
So this gets into like a whole discussion of like, are they credible or not? How much of a negotiation ploy? I think the market right now still believes it's much more escalate to de-escalate, and they won't follow through. There is a risk that, of course, they do, that happens. But it was interesting when those tariffs on Canada and Mexico were announced on the Saturday of 25%. Monday morning when the markets opened, rates went lower, and they actually went higher when they were sort of pushed back for a month. To me, that's an interpretation. The market believes ultimately tariffs will be worse for growth than they are inflationary. The Fed will look through the inflation piece and you're much more about kind of growth slowing down. The uncertainty around it could cause growth to kind of slow quickly. And I think that's what the bond market, that initial 24 hours suggests that. So yes, it could be inflationary, but I think the market sort of view it as more of a growth hit.
But that might be a positive view for the market so long as the inflationary risk doesn't keep the Fed higher for longer.
Well, then you're balancing like what's better, lower rates for the markets or the growth hit. And I think the uncertainty at a minimum means you're probably like sideways, you're probably range bound.
Yeah.
Again, if the lower rates, if it's not recessionary, then there's only so far equities could sell off, but it's hard to get really, really constructive on equities as that's kind of playing out.
Really great overview, Jason. Thank you so much for coming
pleasure.
in studio with us. Really appreciate it. We're going to take a look at a trending ticker on Yahoo Finance. Now, long-challenged EV maker Nikola has filed for Chapter 11 bankruptcy after failing to raise funds or secure a buyer. The company's downfall has been years in the making, mired by a series of scandals and funding struggles. Back in 2022, the former CEO, Trevor Milton, he was convicted of fraud charges related to misleading investors around the company's operations. And remember, the company is one of our SPAC plays, going public via SPAC back in June of 2020. At its peak, the EV company was valued at $30 billion, more than Ford at the time, which is just a great example in kind of these SPAC plays that were really risky. And you just see that massive run up in the stock following its IPO in 2020. And then obviously just the huge move to the downside following that rout in 2021 into 2022 that they just were not able to recover. As a reminder for folks too, this is an EV play. This is one of those EV names that was trying to compete in the broader auto space here. They were able to sign a multi-billion-dollar deal with General Motors at one point, and they were this kind of darling of the auto space, but clearly falling from grace over the last couple of years amid a slew of financial and executive challenges.
Well, yeah, there's also the self-imposed challenge of going and pitching your product when it's really just a question of, man, this looks so good. Is it actually AI? And turns out it was actually closer to being fabricated and AI than an actual real produced vehicle that the company was going to be able to produce at scale, which became the issue. And so now you have the claims of fraudulence that came forward against Trevor Milton. And then you additionally had larger partners questioning, okay, what would be the timeline to delivery if we did even create a purchase order and decide to have you follow through on that? And so that's the larger impact here. They say, like other companies in the electric vehicle industry, they faced various market and macroeconomic factors impacting their ability to operate. In recent months, they also took numerous actions to raise capital, try to reduce their liabilities, clean up the balance sheet, and preserve cash to sustain their operation. Unfortunately, they say their best efforts have not been enough to overcome those challenges.
I want to end on this stat that I think is fascinating. Almost every EV company that went public via SPAC has failed, which is just such an interesting reflection on that era of financial markets and the amount of companies that were going public via SPAC and kind of the froth in the market at that time coming out of COVID and seeing the impact that it has had on some of those names today. Obviously, not every name that went public via SPAC has failed, but interesting to see kind of the struggles in the EV space in particular.
Yeah, no, I'm taking a look, and one of them came to mind immediately. Polestar. Take a look at shares of Polestar, how far that's declined. That was a $20 billion SPAC deal, I believe. And ultimately, it's trading at 20 cents a share right now?
Yeah, penny stock.
All right, we'll continue to watch all these names, much more, everyone. All your markets action straight ahead. Stay tuned. You're watching Morning Brief.
And that is your opening bell on Wall Street. Taking a look there at Fiverr at the New York Stock Exchange. You've also got the Nasdaq on your screen. Want to take a look at markets kind of sputtering into the trade this morning after hitting another record all-time high, the second of the year on Tuesday. By the way, this time last year, the market had already had 11 all-time highs. So when you put it into that context, the all-time high is not as exciting so far this year, but certainly good news for investors. It's interesting to see kind of the sell-off that we saw on Thursday in treasuries in particular. We saw treasury yields moving higher following this idea of more inflation to be baked into the market, perhaps a little bit fueled by the commentary we got from President Trump about tariffs to come on autos, chips, and pharmaceuticals. So we will continue to be having conversations about the impact of those tariffs. As I mentioned here, you see a little bit of a sell-off happening in the major averages. The S&P down nearly 0.2%. Your tech-heavy Nasdaq down nearly 0.2% as well. I want to pull up specifically the Nasdaq here because I want to take a look at the chips names in particular here. And it is interesting to see kind of the move to the upside that we're seeing in the chip stocks. In particular, on Tuesday, we saw chips names being the biggest drivers of movement to the upside in chips names. You can see on your screen here, you've got a lot of these big tech names moving to the downside. NVIDIA coming off of its highs from yesterday following that rally in semiconductor stocks, not necessarily driven by any huge fundamental shift in the semiconductor space, but especially given that news I just mentioned on Trump tariffs on chips names, you'd think there'd be more of a sell-off, but we saw a rally starting in those chips names to start the week of trade this week, and then that did continue into the end of the trading day. But here you can see a lot of pressure on those big tech names, Apple and Tesla and Google, all under pressure for your Mag 7 names in today's trade so far. Let's get to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Hey, Maddie. Well, I thought we'd get back to the S&P 500. As you noted, we just hit another record high, only the second of the year. Same for the Nasdaq 100, but we're going very, very slowly. I'll show you the two-day price action, and just really not too much to the upside or the downside. We had a nice bang to the close, into the close yesterday that kind of saved some of the indices from being in the red, but just not a lot of movement, and that's just fine. I think when we have bull markets, a lot of the time, price action is just boring, at least at the index level, not necessarily at the security level. Here's the Russell 2000. That is leading in early trading. Let me show you the 3-month chart there. It's a little bit different. You can see we have these highs over here, and those aren't even the record highs, but we are down appreciably from those, so that's kind of a catch-up trade. Just going to note really briefly that the 10-year T-note yield and the U.S. dollar index both jumping a little bit. The movement isn't that concerning in terms of the risk rally, so I'll just leave it at that, and we'll skip over to the sector action. We had financials leading early. Financials and tech, those actually notched record highs yesterday. We're not seeing either of those in the leadership positions. We're seeing energy leading, and then the cyclical sectors like materials, discretionary, those are lagging today. Materials down, XLB down about 1%. Got to go over to Nasdaq, where I've been tracking Meta. This would be its second down day, and yesterday snapped that 20-day streak that we've been looking at. I'm going to do a deep dive into Meta in about 30 minutes and look into the potential for a bubble comparison, or we'll investigate that. And let me just show you the one-year chart, though. Very impressive, up 48.8% in that stock, just kind of going gangbusters this year. Want to close with the futures market, where we don't have a lot happening. The metals are kind of quiet today. We see crude oil jumping a little bit, but coffee is catching my attention. This is a one-year chart, too. We came off of the highs, had a steep decline a couple days ago. You don't really see it right there. We stayed close enough to record highs that we are just right back there again. 120%, that is a lot. And these coffee prices, these are the input prices that affect your Starbucks and other retail coffee prices. So something we'll continue to monitor here, but just not a whole lot going on in the major indices. Brad?
Jared, thanks so much. Appreciate it. Teeing up today's trading activity perfectly. It's time now for today's strategy session. U.S. stocks pulling back to start off today's session from those record highs that we saw on Tuesday, but with the market trading near its peak, where can investors find their next opportunity for yield? Joining us now, we've got our markets reporter, Josh Schaefer. Josh, where's the next opportunity?
Overseas, Brad, right?
Okay, all right.
That was one thing we wrote about this
passports
morning in our morning brief newsletter, right, was sort of the catch-up trade people have been finding among global stocks, global equities, actually starting to compete with U.S. equities to start 2025. But one thing I sort of broke down in that column as well, guys, is really It's kind of the same as the catch-up trade that you're seeing within U.S. equities, right? So if we look at the S&P 500 and look at the top performers this year, I'll read through a couple of them right now. Intel, Supermicro Computer, CVS, Airbnb. If we look at all those stocks and thought about what they did over the last year, they all have something in common. They weren't very popular stocks in 2024. And so I think what you're seeing really across the market, across sectors too, when you look at the sectors, materials, energy, some of the best performers in 2025 thus far, what do they have in common? They were laggards in 2024. So you're just seeing a lot of catch-up trade, a lot of rotation, something we were talking about yesterday off the B of A fund manager survey with cash levels so low. Investors aren't leaving the Mag 7 and leaving the market, right? They're leaving the Mag 7 and putting money to work somewhere else. So we're seeing a lot of action in these different catch-up trades. Of course, some individual stories going on there too. I mentioned Intel. There's potential M&A rumors. That's also why people are piling into that stock. But generally speaking, I think we're seeing a clear trend here of stocks that did not perform well last year. People are looking for some way to find outperformance this year, and it's outside that Mag 7 cohort thus far.
And it's interesting, too, given that we are in tax season. I remember Steve Sosnick teaching me that you see some of these underperformers starting to perform really well suddenly in the month of February every year. What does that tell you about what investors are doing with their capital gains taxes? Having said that, Josh, I think it's really interesting to think about kind of where we're seeing the market momentum coming from. And it does seem like we are cementing a narrative that it's no longer driven by those Mag 7 names. Does something like NVIDIA earnings coming up change that? Do we get a return to those Mag 7 names as people look for more of a safe haven trade? It
certainly puts them back into focus next week, right? When we think about the different sort of headlines we have coming at us, I would imagine the tariff headlines are going to heat up a little bit more leading into March next week. But also it seems like NVIDIA is probably the headliner next week, Maddie, yes. And we've sort of been waiting for more commentary post DeepSeek, right? And I bet that's going to be a big focus of that call. I mean, Mag 7 earnings outside of NVIDIA didn't really do a lot for that cohort, right? Save Meta, which has done very well this year, and the market seemed to like their earnings. Earnings haven't been that friendly to the group thus far, so it'll be interesting to see how it works for NVIDIA. I mean, NVIDIA, even the last couple quarters, hasn't necessarily seen a big pop in its stock, right? You look at NVIDIA shares over the last couple weeks, it's been on this trend of rallying into earnings, but not necessarily rallying post earnings. But we know what they say can sometimes drive a little bit of an AI narrative. But I would argue, generally speaking, the AI trade is still performing. It's just not really the Mag 7 at this point.
I want to come back to what we can effectively call your passport trade a hot second ago here, because this was something that was also evident within what Macquarie was saying, and that hit our inbox yesterday, talking about globally they see areas of opportunity, valuations outside the U.S. more attractive, economic stability scarcer though. They did warn and caution here, and I wonder how traders are kind of balancing that, the economic side of the potential instability of some of those markets versus where the valuations present an opportunity.
Yeah, Brad, so the valuations definitely present an opportunity, right? And then, as you said, sort of the variable is economic growth. But one thing that was interesting that I was looking at yesterday, if you look at sort of just consensus projections for the Eurozone or for UK economic growth, GDP growth, it's supposed to tick up slightly in 2024. Into 2025, if you look at the US, we're supposed to come down, right? And very often in investing, we're talking about rate of change, not necessarily level, right? Where is my growth increasing? So I think part of what investors are seeing across the globe is, okay, across the globe, economic growth hasn't been that great in a lot of areas for the past couple of years, not nearly as strong as the US. But if it's going to pick up, then perhaps that's my area of opportunity. Again, you mentioned a lot of variables. We haven't even gotten to the point of talking about Euro tariffs yet, right? And what if we start tariffing those countries, and how does that impact them? But just generally speaking, they're coming off a lower level, so there's perhaps more room to outperform. When you're looking at the US economy, we're expecting about 2.2% annualized GDP growth. There's not a ton of room to outperform there. I mean, there is, but that would be very impressive from the US economy. So we're sort of priced in a lot of positive growth here, and people are arguing outside of the US. We haven't priced in a ton of good news. So maybe there's opportunity for some more good news to come in and actually be a catalyst there. We've already had a lot of strong catalysts here over the last couple of years.
Certainly. One of them, though, that's a big question mark, and I love this line from BNP Paribas saying this morning that the Fed is comfortably numb right now, and that's not necessarily going to be a catalyst for Wall Street this year. So something we'll continue to monitor. Josh, thank you so much. Appreciate it, as always. Well, President Trump's economic team is focusing more on Wall Street and less on the Federal Reserve. Here to break it all down, we've got our Fed correspondent, Jennifer Schomburger. Hey, Jennifer.
Good morning, Maddie. Treasury Secretary Scott Bessent again pushing the administration's strategy to lower long-term borrowing costs for Americans by pushing down the yield on the 10-year Treasury. Comments he made again last night during an interview on Fox News. At the same time, National Economic Council Director Kevin Hassett also pushing that narrative over the weekend, saying if we can get inflation back down, that could take pressure off the Federal Reserve. Now, officials intend to try to push the yield down on the 10-year through policies that promote economic growth, productivity, and cutting government spending. Now, yields move inverse to price, so inflation tends to drive up yields as investors demand more compensation since inflation erodes the value of a bond. James Fishback, CEO of investment firm Azoria, says he believes the policies will lower inflation and boost growth, acting to push down the 10-year yield. He points to Elon Musk's Department of Government Efficiency, which he believes will trim wasteful spending and reduce fiscal pressures that can push inflation and yields higher. Now, Musk said on X that, quote, as it becomes clear Doge is working, you will see the long-term Treasury bill yields fall. Wilmington Trust portfolio manager Wilmer Stith said he believes Bessent's biggest tool for lowering the 10-year bond yield is to lower the deficit, pointing to Doge, and thus lower the supply of Treasuries. The Treasury Department indicated in its quarterly refunding statement on February 5th that it's not expected to increase the amount of Treasury supplies for at least the next several quarters. Now, tariffs could be a wild card depending on whether they prove inflationary. LPL Financial says initially tariffs could actually push yields lower as investors treat treasuries as a safe haven during uncertainty. However, if we see substantial retaliation and escalation and those tariffs do prove inflationary, then yields could ultimately move higher. Guys?
Jennifer, thank you. Coming up, everyone, the outlook for oil this year, what it means for energy companies, and one big bet by Warren Buffett. That's next on Morning Brief. Occidental reporting mixed fourth quarter results, beating on earnings but missing on revenue. The energy company also announcing 2 deals in the current quarter to divest some of its upstream assets to undisclosed buyers for $1.2 billion. Joining us now, Stuart Glickman, who is the CFRA Research Energy Equity Analyst. Great to have you here with us. Just first, want to get your reaction to the results.
Thanks, Brad, for having me. So results pretty good. They beat handily, 80 cents on the quarter. well above, the 67 cent consensus view, and actually better than last year's at 74 cents. I think Oxy is doing a pretty good job at sticking to its knitting and delivering as best it can. In an environment where oil prices have been choppy and natural gas prices have been somewhat choppy. But as far as the print goes, pretty good results.
So pretty good results, but as you mentioned, there is this challenging macro backdrop for any company in the energy space right now, given the pressure we've seen on crude prices. To what extent do you think that continues to be a challenge for Occidental moving forward?
Yeah, Madison, great question. So I think all you have to do is look at OPEC Plus and see what they've been doing over the last several months, which is continually pushing back the start of the unwinding of the 2.2 million barrels a day of voluntary production cuts. Why are they pushing it back? They're pushing it back because they're concerned about demand, and they are worried about flooding the market and sending prices plummeting through the floor. So I think there are real concerns about where incremental oil demand is going to come from. The Chinese economy looks pretty wobbly. India is growing, but India is not anywhere close to the size of the Chinese economy. And Western markets, year to year, don't improve demand all that much. So if you're not going to see a lot of growth coming from Asia Pac, where are you going to get those incremental barrels from? That, I think, is the backdrop that people are concerned about. Certainly OPEC Plus is concerned about it. And the U.S. oil community, as stingy as they're being about developing new oil and gas, or their organic spending is really not particularly strong, they are still delivering production gains year on year. We think the U.S. probably averages around 13.5 million barrels a day of oil production in 25. That's up a little bit from about 13.2 in 2024. So you've got growing non-OPEC supply. You've got OPEC Plus holding off because of concerns about demand, and of course, the demand concerns. All of that points to a backdrop where we don't think oil prices are going to be all that attractive this year. We're looking at something like $65 a barrel for WTI.
So what's that pass-through mean for Occidental here, especially as it's a stock that's been down 14% over the past 52 weeks. It seems like a lot of it has been kind of buoyed by the Buffett narrative and his buying. But outside of that, where are the other major catalysts for growth that you're anticipating to come to fruition?
Right. So Oxy has a couple of irons in its fire. One is the Crown Rock acquisition that they completed in mid to late 2024, adjacent to a lot of Oxy's other acreage. And that's important because when you have adjacent acreage, you can run longer laterals, you can squeeze down unit costs. We've already started to see that in Q4. Oxy was able to eke out about an 8% unit cost reduction on those Crown Rock assets. As they get to know the acreage a little better, there's a chance that they can probably squeeze out a little bit more. So that's a plus. They're one of the leaders in the industry in carbon capture sequestration, which is another plus for the industry. Certainly nobody wants to, send excess carbon up into the environment if you can avoid it. So those are pluses that they have that are kind of under their control. The things that are the concerns for Oxy, of course, are the macro backdrop issues that I pointed to. Mm-hmm. And Oxy also has to contend with a somewhat levered up balance sheet, right? Their net debt to cap is around 42% right now. That's, materially higher than the average E&P. Most E&Ps are going to be closer to 30% or a little bit less. So, we talked about just earlier in your intro, you talked about some non-core asset sales. Mm-hmm. I think the reason for that is that they're going to use those proceeds to help get that balance sheet back under control. Higher oil prices would help, but you can't count on that, of course.
And just lastly, while we have you here, Stuart, just to follow up on the Buffett effect here, how much do you anticipate that investors are actually expecting Warren Buffett to continue to buy into Occidental, even with the allocation that he already has within the Berkshire Hathaway portfolio, and now trying to figure out, okay, even if we do see even more continued slippage, what he would feel comfortable continuing to allocate towards Occidental?
Yeah, Brad, that's a really tough question to answer. He's certainly mercurial. Hard to know, when, of course, he's going to step in and add to his position. I think that, certainly Warren Buffett has always been sort of like a believer in the long-term picture for any company that he invests in. And so him investing more into Oxy isn't necessarily a view that, the next 12 months are going to be great for Oxy. It may just be that, he's thinking about the bigger picture longer term. And to be fair to Mr. Buffett, I think longer term, the outlook for a lot of energy companies is pretty good because the lack of spending at the oil field is going to eventually come back to bite. Non-OPEC supply growth isn't always going to be positive. So we could, perhaps by the end of the decade, start to see oil production roll over because of that lack of spending. I just think that from a near-term catalyst perspective, this year looks more of a headwind kind of year than a tailwind.
Really good analysis as always. Stuart, thanks so much for taking the time here with us today.
Thank you.
We've got much more of your market action after the break. Stay tuned. CEOs for 5 of the country's largest Wall Street banks all saw pay bumps in 2024 compared to the year prior. But one stands out as the largest, and here with the reveal, we've got Yahoo Finance banking reporter David Holler. David, what'd you find?
Hey, Brad, we now have compensation for 6 of the country's biggest Wall Street banks executives. And Jane Fraser, Citigroup CEO, stands out as having total pay that has seen the largest increase from last year. Fraser received $8.5 million more, which made her compensation come in at a total $34.5 million for the year of 2024. So again, their compensation's paid on their performance or their bank's performance also from last year. Now, Fraser's award also comes as as a consecutive year rise in her pay. It's also higher than Wells Fargo CEO Charles Scharf and Morgan Stanley's newer CEO Ted Pick. The 2 big bank CEOs who came in with the highest total compensation were Goldman Sachs's David Solomon and JP Morgan Chase's Jamie Dimon. They both had $39 million in total compensation. So again, actual payment in turn comes in a mixture of cash and stock incentives and performance units. And the actual base pay of cash for all these executives ranges between $1 and $2 million to $3 million. So we do have a range there, and they can't necessarily spend all of this money in one year. But it is notable that Fraser saw such an increase. She's trying to lead Citigroup through this multi-year turnaround effort, and things weren't all perfect, but she did definitely show improvement, and the board compensated her for that.
Exactly what I wanted to follow up on, David. It is interesting to get that degree of a pay increase when you are in the midst of cost cutting at your own firm. What do you make of that kind of cognitive dissonance at Citi?
Yeah, I mean, I think that just judging from the filing, what the board has pointed out is that she's been prompt in executing on her targets. And it's also notable to point out just in July, Citi was hit with another regulatory order related to they're not addressing quickly enough some data issues they've had, and they've talked a lot about that, and Fraser's addressed it. So there is some tension here about whether or not Citi can actually execute. They're also they tailored back an efficiency target that Fraser had previously set, but they still are making strides. And the turnaround efforts for Citi is sort of a decade-long conversation. And so it seems like the board is at least backing her and supporting her compared to that. Again, Fraser had the lowest pay in 2023. So this is a significant jump, and it shows that the board at least is supporting her decisions.
All right, David, thank you so much for joining us and breaking that down. We appreciate it. That's going to do it for Morning Brief. You can join me in the next hour for more analysis on Catalyst and Brad at 11 a.m. Eastern for all of your wealth news. So keep it here on Yahoo Finance for more. Welcome to Catalyst. I'm Madison Mills alongside Alexandra Canal. We are 30 minutes into the U.S. trading day. Let's get you the 3 catalysts we're watching this hour. First up, we're going to hone in on the big tech trade as Meta's $320 billion rally comes to an end.
Plus, we dig into investors' rate cut expectations with Fed minutes out later today.
And a look at antitrust expectations under the Trump administration as the White House looks to mirror Biden's approach. Shares of Meta extending declines after snapping a 20-day winning streak on Tuesday, closing down by nearly 3%. The multi-week rally adding more than $320 billion to the company's market cap. Joining us now for what's next on Meta and some of the other big tech names, JJ Kinahan, Tasty Trade at IG CEO. JJ, thanks for being here. You make a pretty bold statement on Meta. You say investors have turned bearish on the name. What do you make of that, given the run-up that we've seen into this really brief and kind of insignificant pullback in the context of that run-up?
Well, I think that you hit on it right in the intro there when you said, 20 days in a row, basically. This is a stock that in 2.5 weeks went from 670 to 740. Just seemed like a runaway train almost to the upside. And it's fantastic. And I just think what's happened over the last week, I actually don't know that this is necessarily a longer term trade for many people. But I think what happened is people were looking at this and saying, okay, this is kind of insane of how fast this stock has gone up without really taking a breather. And so I think many people were just playing it for what has happened over the last couple of days and seeing, things come back to earth a little bit because the pace it was going at seemed absolutely incredible, especially given what was happening to some of its peers and the fact that, other stocks were acting, I'll use the quote, more normal in terms of how they were going up with some down days, et cetera. So I don't know that necessarily this is going to be, when we talk again, hopefully in a couple of weeks, I don't know that this will be a stock that I'll be saying that our clients are necessarily bearish on longer term, because this is one that if I look back just a month and a half ago was, almost 75% of the activity was buys. And you have to remember a normal for a retail trader is about 52% buys, 48% sells. And so when I see a stock like Meta right now, where we're seeing, almost 60% of the activity to the bearish side over the last 7 days, it just tells me that A, some people are taking profits, B, some people are just saying this move seems a little bit out of hand. And as I just looked at the numbers in the first, obviously we're only 30 minutes in, looking really quick coming in this morning, we are starting to see some people take off some of those positions and cover based on, be those options or stock positions based on the movement we've seen the last 2 days.
Now, JJ, that being said, though, Meta's run has outpaced all of its Mag 7 counterparts. So what does this signal about the investor appetite when it comes to tech? Obviously, we're still in a very concentrated market. Valuations are stretched. But does this signal maybe perhaps some buying opportunity?
Well, Alexander, I think it absolutely does. And the other part about it is, the AI game continues. I think it's still, as we're starting to see more and more in the last earnings conference calls, it's now okay, you've spent this incredible money. And besides helping middle schoolers cheat on their papers and an incredible search engine, what are we really getting done? And I think we're all incredibly excited about what can actually come from this, particularly not just in the technology sector, but in the medical technology sector also. I think maybe the most exciting place that is eventually truly transformed by AI. But that all said, it's been billions of dollars spent with returns that I think everyone's left scratching their head. However, with that said, you have the biggest players in the industry all here spending that money, all of them with lots of cash in order to do so. So we are going to start to see, in my opinion, over the next year, you are going to see a lot more developments happen there. And when you have a company like NVIDIA, which obviously reports next week, I think the one thing many of us will be looking for in that is, do we still see overwhelming demand? I believe was the term, perhaps I'm paraphrasing a little bit, from their CEO in terms of what they are seeing. And all what the stocks are showing us right now is that seems to be the case overall.
Yeah, it's interesting because you say that the bulls are back when it comes to NVIDIA, but the stock is down about 0.3% year to date. What is the bull case for the company?
Well, I think if you look a little bit more, though, and you say, okay, what happened with DeepSeek? Here's a stock that's made back just about 90% of what that DeepSeek news was in terms of a threat overall. And so, again, I think also, when you head into such a big earnings, which they have now become, people may be a little bit more reluctant until it's a little bit of the show me case now in terms of what they will come out with next week. As I look at the options market here, we're pricing in about a 7 to a 7.5% move on those earnings numbers. So I think that also maybe have people holding back a little bit more. And so, in general, there is a lot to be excited about. And also the fact that if you look in 2024, this was a firm that in their fiscal year beat earnings on all 4 reports in terms of expectations. So I think that is also something that people have to look at.
Do you think the DeepSeek risk has not been appropriately priced into this stock? Because it seemed like it was a big deal, and then all of a sudden it wasn't. We're getting some headlines today that they're reportedly seeking some outside funding. So what do you make of how investors have digested the DeepSeek news?
Well, I think that it's again, sometimes the news from China can be a little bit tough to figure out in terms of the accounting. I think what I would say is that, if you look at what portion of development, when they said they did this for, I think it was $26 million, what part of the development are you talking about? You're talking beginning to end, and everything we're starting to see says, well, maybe not beginning to end, but maybe at the end processing, et cetera. So I think that there is what people have done is say, hold on, let's compare apples to apples compared to apples to the very small slice of an apple. And so that is why I think there remains some questions. However, I do think the real positive that came out of this overall was perhaps we as a country and maybe the tech industry had a little bit of sense of, I don't want to use the word arrogance, but we are superior and nobody can ever catch us. And so I think with this, it has been a bit of a wake-up call, which usually serves as a really good thing in business for people to say, hey, others are out there and they're going to compete just as hard. So you have to be sharp in your game the entire time. And that overall tends to be a good thing. And I think for NVIDIA, we're seeing with how the stock has responded back positively, it has been a good thing overall, and the continued rally in the chip and the sort of more full sector plays that you get with an NVIDIA.
One more tech name before we let you go. Apple, you're seeing bullish signals. What's the activity telling you?
Yeah, so we're seeing about 75% of the activity in Apple being positive right now. And, as we continue to see some of the AI with phones, et cetera, I think Apple was under a little bit of a cloud for a while. It's certainly come back. For so many years, Apple was sort of the favorite of retail. That fell out a little bit over the last year or so, but in the last 3 to 4 months, since the holiday season started particularly, we're starting to see a greater interest in Apple again from the retail trader overall. And that is, it's back in the top 5 names every single day after being, as I said, number 1 for so many years. So people continue to want to buy the stock, see the potential going forward, even with some of the geopolitical risks that it may have.
JJ, thanks so much. Appreciate your insights.
Always
We always love talking tech.
Thanks, ladies.
Well, to give a bit of context to Meta's recent run, markets and data editor and host of Stocks in Translation, Jared Wickery, joins us now to take a closer look at how the social media company's winning streak stacks up to longtime AI darling NVIDIA. Jared, what did you find?
20 days is really impressive. 20-day win streak here for Meta, and you can see it's up almost 20% on the year, which is a real standout when you compare it to these other mega caps. So considering the huge run-up that we've seen in NVIDIA, and I'll put this on a 3-year basis, you can see NVIDIA up 480% on this time frame. Going back 3 years, Meta up 238%. But how do they stack up in terms of the market cap gains? And that's something I was looking at right here. This is a 5-year chart, and this shows the rolling 1-year change in market cap over 12 months. And in white, we have Meta, and in NVIDIA, we have green. So in white here, you can see both of these securities, both of these stocks took a nice dip in 2022. That was that nasty bear market. That was when Meta cut their costs and a lot of heads in that area. But then they both had a resurgence. And by 2024, about Q2 or so, it was heading north of $2 trillion gained over the prior 12 months. And it fluctuated a bit, but it actually peaked out at about $2.5 trillion in December of last year. Meanwhile, Meta was continuing to tack on gains. And by the way, if this goes sideways, that means it's still adding to gains, but just at the same rate. So Meta kind of plateaued here, and even notwithstanding the 20-day win streak, we didn't really see much of an acceleration in terms of its market cap gains. So NVIDIA right now is just within a few percentage points of its record high, and I don't think that constitutes a bubble. You need two sides for the bubble, and so if NVIDIA is not in a bubble, I don't think Meta is either. But I also thought it was interesting to gauge how the Mag 7 stocks have contributed to the S&P 500 gains over the last few years. So I have 2023, 2024, 2025. The biggest difference you're going to see is this year we have a few losers. Those market cap losses going south there. And for that we have Apple, Alphabet, Microsoft, and Tesla. Tesla's down about $157 billion, so it's leading down this year, but you're also going to notice a few standouts. Now in 2023, there were about $5.1 trillion in market cap gains from the Mag 7, and this constituted 62% of the S&P 500 gains. The next year was similar. It was actually a little bit more market cap, $5.5 trillion, constituting 55% of those gains. And this year, well, it's only 126 million. That's about 1/30 of what we saw last year, and that percentage works out to about 5 or 6%. Now, we still have some standouts. In 2023, Microsoft was leading the charge, though we had a number of others that contributed similarly, Apple here and NVIDIA. But then in 2024, it was really an NVIDIA story, and that really stands out there. This year, guess what? It is a Meta story. Meta is kind of carrying the water for the Mag 7, arguably for a lot of the S&P 500 itself. So when we take it, to wrap it all up here, when we take a look at what's going on beneath the surface in terms of the mega caps and their market cap gains, it indeed looks like we have a healthy rotation in this market in 2025 because the S&P 500 and the Nasdaq 100 are hitting record highs, and yet we don't see the Mag 7 participation we used to. All of that just points to a healthy rotation in this bull market.
All right, Jared, thank you so much for breaking that down for us. We appreciate it as always. Coming up, Arista shares still moving to the downside after company earnings disappointing with one specific big tech customer. We're going to break down those results for you next on Catalysts. It's now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Arista Networks issuing a stronger than expected first quarter revenue forecast. The computer networking company also beating estimates for the fourth quarter, but it did see a 17% decline in revenue from Meta, one of their biggest customers. The stock under pressure as analysts warn about the company's reliance on Meta. And it's really interesting. Meta makes up about 20% of Arista Networks revenue. Microsoft makes up about 18%. So seeing that 17% decline in Meta revenue is really critical for the company, which, as a reminder, just for folks who may not be familiar, this is a cloud networking firm. They also provide AI-driven and data center products specifically. So that's one of the reasons we're seeing a company like Meta be such a critical customer to them. You think that Meta's AI capex increasing would be good for a company like Arista. So then to not see that coming through has been disappointing to investors.
Yeah, a little counterintuitive there. The concentration concerns really seems to be probably the sole factor dragging down the share price today, because everything else looks good. I mean, coming into the print, there were some tempered expectations following DeepSeek, following some competitor reports. But outside of those meta risks, I mean, analysts seem overall very bullish on the stock. We have 16 buys, 4 holds, just 2 sells, according to the latest Bloomberg estimates. Year to date, we're down around 7%. So it seems like what happened with those shares results that we're seeing today taking a big drag on the stock from a year-to-date perspective, but over the past 12 months, we're up over 55%. So a company to continue to watch as we always talk about the AI potential and what this next wave of the AI trade will really be.
Especially as that spending is expected to continue despite some of the headwinds from the likes of DeepSeek, which I know we're going to talk about.
Yeah, transition here to Alibaba. The Chinese e-commerce giant weighs investing in AI startup DeepSeek, which is considering outside funding for the first time. That's according to a new report from The Information. So DeepSeek so far has not raised outside funding. They've been a little bit hesitant to do that. They don't want to commercialize their products too quickly, but the need for more AI chips, the need for more AI servers, and just the sheer panic, excitement, euphoria, whatever you want to call it, that we saw last month when it comes to that cheaper AI chatbot, it's leading this company to consider that funding. That's, again, according to The Information. There's also been discussions about whether they should pivot away from primarily focusing on research and maybe towards building a business that generates some profits, some revenue. But the DeepSeek founder, he remains cautious. So it's still a big TBD whether or not this will happen. But again, Baba reportedly considering investing in the company and some other China funds as well.
Which, to your point, so interesting given that just 2 weeks ago, Baba said we were absolutely not considering this investment, and now suddenly DeepSeek's open to it, so is Baba, which makes sense given that the usage of DeepSeek has really skyrocketed following news about the viability and efficacy of its AI offering here. It's also interesting to see them transitioning potentially to this for-profit model. That's something that investors and sources I've been speaking with have really pointed out is the critical differentiator of DeepSeek. If they do find a way to make a profitable AI platform, that could put further pressure on some of these American-based companies that are offering AI tools like an OpenAI, which has not transitioned to that for-profit model perhaps as successfully as some of the competitors in the space.
Yeah, and look, they have the momentum, right? I mean, everyone is talking about DeepSeek, and they weren't a few months ago, and now all of a sudden to kick off 25, it's all a lot of companies and a lot of investors are chatting about and they're focused on as we think about the future of these trades and also those hyperscalers.
Right, and they need more chips to fuel all that usage going on. We're going to transition to a consumer-facing name here, Etsy, missing fourth quarter revenue estimates, weighed down by weak holiday sales. The online marketplace citing consumer spending pressure, a short holiday season, and a competitive retail environment. But interesting to note always when you compare across the retail space, that holiday shortened environment was the same for everybody. It didn't impact everybody negatively. So that's important to note. Those shares down about 9.5%. What's really interesting for Etsy, they've been in this route since 2022. They saw a huge run up following the pandemic, and then you've seen just this severe move to the downside, and they've been in this kind of holding pattern, kind of sputtering along over the past year here, and you can really see that playing out in your screen since about May of 2024. They were able to hit a revenue record, a historic record on revenue, but their global merchandise sales fell. And if they don't turn that piece of the business around, that's something that people are concerned about and investors are concerned about when it comes to screen time and the amount of spending on the platform being able to continue.
Yeah, and the merchandise sales, that reflects a drop in discretionary spending. And we always talk about the consumer here and the health and the resiliency of the consumer. We did get that not so great retail sales number for the month of January, but a lot of economists, a lot of strategists basically saying seasonality, weather. We had a really strong December, but interesting to see and continue to track the moves that we're seeing throughout the consumer at large. And with weaker gross merchandise sales in the fourth quarter, that's likely to continue in the current quarter. So something to continue to watch for this company. Stock, as you mentioned, was down about 25% over the last 12 months. It's underperforming the S&P 500. It seems like we need another catalyst here for really boosting those share prices, because it's not a cheap stock either at current levels.
Well, and perhaps that catalyst is within Etsy. They are the owners of Depop, which we were just talking about. It's kind of like a Poshmark, an online marketplace for those not familiar, a little bit more vintage leaning. But Depop hit a record in terms of global merchandise sales. So maybe if they're able to lean into that platform, which could also be an indicator of consumer weakness, if people are looking for that resale option, something that you and I maybe need to.
I know I haven't used Depop, but you're telling me that I need to do it. So with all the weddings and all the work events, everything coming up, I might have to look into it.
It's an affordable wedding guest dress option out there. Exactly.
It ain't cheap to go to weddings.
It ain't cheap to have friends. All right, folks. Well, as we head to break, we want to hone in on healthcare as Yahoo Finance executive editor Brian Sozzi spoke with Bausch & Lomb CEO Brent Saunders on Opening Bid this morning about the growing problems facing the industry. Take a listen.
I think there's a lot of blame to go around. It's a very complex system with lots of different moving parts. And I think the fix is quite complicated, but if I had to pick one area to really focus on to fix it, I really think it's quite simple: transparency. I think that, if we look at what Doge is doing, right, and whether you like it or dislike it, the one thing it's hard to criticize Doge on is they're bringing massive transparency, right? They're putting out on the web or on X every day, what they're doing, what programs are being canceled. We should have real pricing transparency on healthcare services in the United States. We should understand why we pay what we pay, where you can get it perhaps at a lower cost, who's getting paid, where is the money going. And I think if you do that, you're going to find a lot of inefficiency in the system.
A big question on Wall Street is how President Trump's tariff agenda could impact the Fed's path forward, especially when it comes to inflation. Earlier this week, Fed Governor Michelle Bowman said she's looking for further confidence on inflation's downward trajectory before considering further cuts. Meanwhile, Fed Governor Christopher Waller advocated for a pause in easing, but also said, quote, waiting for economic uncertainty to dissipate is a recipe for policy paralysis. Joining us now for more, we've got Thomas Honig, former Kansas City Fed president and also former director of the FDIC. Thomas, great to have you on. Thank you for making time here. Talk to me about the path forward for the Federal Reserve, given the stickiness of inflation. This morning, I read BNP Paribas saying that the Fed is comfortably numb. Would you agree with that characterization?
I would say that a comfortable part of it may be a little of an overstatement. They are certainly holding where they are. And I don't know that they're all that settled, because with inflation going up the last couple of months, and given where their interest rates are, and their real interest rates are now well below 2%, they have been a little more concerned about inflation, and they should be more concerned about inflation. So I don't think numb is the right.
Thomas, did we lose him? I think
we might be losing you, Thomas, so we're going to see if we can get you back. But Ali, I think it's really interesting hearing him kind of talking about the question about whether or not the Fed is right to be in this holding pattern. And it points to something that so many investors have talked to us about on the show, the idea of whether or not the Fed has a central thesis that's driving it, and something, of course, you can continue to talk about with Thomas.
Yes, we have Thomas back now. And Thomas, I want to pick up that conversation because markets are pricing in between 1 to 2 rate cuts this year. If we do see rate cuts, you were mentioning how inflation has been sticky. Are those cuts going to be a result of decelerating inflation, or are you concerned that we could see a potential hit to growth, maybe a deterioration in the labor market, especially when we think about some policies that are circling around Washington with tariffs and some other global concerns?
Well, I think your situation right now is a great deal of uncertainty, right? Around the tariffs. We don't know what they're going to be exactly. We keep talking about it. They will have impacts on our domestic economy as well as other economies. So those are things that you can't really know. And so it adds to the uncertainty, and that slows people's so-called animal instincts to invest and to go forward. So that is a risk that we have. I think, though, that remember, the issue that they have right now, though, is inflation is not coming down. And so they really have to hold rates. So if there's something that happens, an unexpected slowdown, a banking problem, then they will be under a lot of pressure to lower rates, number one. Number two, even if things stay where they are, given the size of the national debt and its growth rate in terms of its deficit, that's going to put pressure on having to finance that debt. That puts upward pressure on interest rates, and they have to deal with that as well. Do they say, well, we'll offset that and buy those securities and then push interest rates down? That has more implications for inflation. So they're in a tough spot right now, is what I'm trying to say.
They are in a tough spot, and it's been interesting in the context of some of the Fed speak this week. There's this idea from voting members that they just have to look past policy from the Trump administration. But I wonder how difficult that is, especially given some of the cost-cutting measures we've seen from DOGE. If we take a look at layoffs just in D.C. in particular, some of the biggest layoffs in history, you can see jobless claims in the D.C. area here really ticking up. Could cost-cutting efforts from the Department of Government Efficiency combined with these layoffs potentially cause a recession, especially if the Fed is not willing to take a look at the impact of policy from the White House?
I think that even though the numbers are coming up in Washington, D.C., I think in the national scheme of things, we still have a very strong labor market. And I'm going to suggest that many of those who are being unemployed in the Washington area can find other jobs, perhaps not where they want, though, and that may be a problem. But I don't think that's going to cause a recession itself. Now, if this picks up in terms of news and you start affecting businesses' decisions, and you add that to the inflation, and you add that to the other actions that are being taken in terms of tariffs, well, then you can create a certain degree of fear and greater uncertainty, and that may slow the economy, and that would put more pressure on the Fed to lower rates, even as the debt continues to grow. And I think even as real rates have come down quite a bit. I mean, they're well below 2% right now. If you look at where the policy rate is at 4.25% and where inflation is at 3%, your real rates are certainly at neutral, lower than that. So you have a mildly accommodative policy possibly, and that means inflationary pressures will not recede anytime soon.
Thomas Honig, appreciate your insights. Thanks so much. Coming up, antitrust under the Trump administration, why deal-making may not see the uptick many were expecting. That's next on Catalysts.
In a blow to Wall Street, the Trump administration says it will keep Biden-era guidelines for reviewing corporate mergers. Investors were anticipating an increase in deal-making with easier antitrust regulation under Trump 2.0. Joining us to discuss the news, Rebecca Hollinsworth, Vanderbilt Law School Associate Dean for Research and Professor. Rebecca, great to have you with us here. What does keeping rules of the Biden era mean? Walk me through kind of operationally what this looks like and what it means for M&A.
Yeah, so in 2023, the Biden administration put out new rules about how the agencies, the FTC and the DOJ, were going to internally review mergers for whether or not to try to block them in court. And they were thought to be a lot more stringent than what came before. This was kind of a part of the Biden administration's, tougher on mergers, more aggressive antitrust enforcement. And I think in somewhat of a surprising move, the Trump administration, at least the FTC, has announced that they're going to keep the merger guidelines in place, at least for now. It's not law, it's not binding, but it's a description of what the agency will do going forward.
So what's some of the criteria here that the FTC and the DOJ use to determine whether or not to seek to block a merger?
Well, it used to be under the old guidelines that you had to basically show two horizontal competitors, so competitors selling substitutes, were merging in a highly concentrated market in order to get serious scrutiny from the FTC or the DOJ, and then ultimately to maybe have it blocked in court. The new guidelines describe a lot of other factors that might give rise to challenges. So, vertical mergers or mergers between complements, mergers that affect the concentration of buying power, including buying power of workers, being a big one. So it's just a broader set of considerations that the government will consider.
It's interesting because the market has been so bullish on easing M&A regulation under Trump 2.0, and we've, as part of that, seen this huge run-up in financial stocks because of this idea of increased deal-making. You can see on your screen the financial sector up 7.5% year-to-date, beating out some of the other big sectors as well. How offsides do you think the market has been in pricing in an easier backdrop for deal-making?
I think it's been off. I think this is surprising. However, I would have always said, and I did always say, that our confidence in these predictions is low. We just didn't know what Trump was going to do. And part of that is because this push for stronger antitrust enforcement and stronger merger enforcement in general, blocking more deals, started with Trump 1. So it wasn't ever clear to me that, obviously they're going to back off. They're going to let mergers go through that didn't go through under Biden. I would have thought that is more likely, and maybe that's what got priced into the market. Yeah. But the confidence in that prediction was never should have been high.
Especially given the closeness we've seen with some of the big tech CEOs attending inaugurations, sitting ahead of some of his own advisors. Do you think that these Biden-era regulations are going to be specifically targeting or specifically negative for big tech as opposed to other maybe smaller cap companies that may have an easier time with M&A?
Well, I think you've kind of put your finger on it, which is, tech and mergers and industry is not a monolith. So there are going to be winners and losers in this administration's attitude towards mergers, and I think it's very unclear who those winners and who those losers are going to be. I think that big tech, there's still some political capital in going after big tech. Elon Musk is not Google, is not Apple, but it's just very hard to say who's going to be the winners and the losers.
Now we're in Trump 2.0, so we can look back on history as a bit of a guide, you could say. So in Trump's first administration, how tough was he on mergers?
So tougher than what came before, and not as tough as the Biden administration. So Trump's first administration challenged a vertical merger in telecom. That would have been somewhat unusual and maybe not at all happening during the Obama era. And then Lina Khan, when she was in charge of the FTC, and Jonathan Cantor in charge of the DOJ under Biden, they really went for it. So, will this be a pullback a little bit? Will it be the same? It's very hard to say. But we look at history and we say Trump 1 versus Trump 2. It's very hard to really make any generalizations about Trump 2 from Trump 1, as we're seeing across the administration's choices.
How surprising is it to you that they are branding this as a continuation of Biden-era policies as opposed to just given the rhetoric that we have seen from the administration, they do tend to find a way to make the old their own. Did that characterization catch you off guard?
I think it's really surprising. I would have thought that Trump and Trump's, people in his administration would have wanted to show a discontinuity with Biden. If anything, maybe a continuity with their first administration. They could have framed it that way, saying, these are priorities that we pursued in our merger policy the first time around. But instead, they kind of went for this almost like rule of law, continuity, stability point, which I think is not what we've seen from the rest of the administration in terms of their branding. I think that's right.
And you mentioned that stability point, FTC Chair Andrew Ferguson arguing that. Now, do you think this means that we will continue to see just stricter restrictions around M&A moving forward, even beyond this administration?
Oh, beyond this administration, I mean, that's a long ways off. It's hard to say. I mean, certainly if he had jettisoned the guidelines today, then that would be less stability, long term, and we could have said that. But, it's 4 years away. It's a little unclear from the memo to me whether this stability he's hoping, Andrew Ferguson is hoping will last through all 4 years. He left open the idea that maybe they would revise or pull out of the guidelines at some point later, but for now, they're going to keep it. I think that's really all we know.
All right, Rebecca, thanks so much. Appreciate your time.
Thank you.
President Trump taking to Truth Social this morning to back a House budget plan calling for a $4.5 trillion tax cut, slapping back Senate Republicans' efforts to rush through funds to help bolster his immigration crackdown in favor of a larger bill that will likely take months to negotiate. So Trump really getting in the middle here of this ongoing budget conflict. We have a key congressional vote coming up. The Senate plans to vote this week on a budget that would add $150 billion in military spending and also increase immigration and border enforcement by $175 billion. So Senate Republicans say they prefer to focus on this, leave budgets aside for now, but Trump wants to really back this sweeping House bill to essentially tackle the federal spending. But that brings into question, too, the deficit, right? And a lot of these tax cuts on both sides of the aisle, both Republican and Democrat, have wondered how that could add to the ongoing and ballooning deficit that we see.
There is this idea that the tariff announcements that are nearly every day coming from the White House are going to pay for these tax cuts. So perhaps President Trump's push towards what he calls, quote, one big beautiful bill is an effort to increase some of that viewed revenue, not realized revenue, in anticipation of these debates about tax cuts within the Senate. But it is interesting to see him sort of rebuffing Senate Republicans who did want that $175 billion in increased spending for immigration enforcement specifically. We're now seeing him, again, pushing for that bigger reconciliation bill that will include kind of a one and done. This is something that Treasury Secretary Scott Bessent had also teased out earlier this year. And even in my conversation with him here on Yahoo Finance, the idea of pushing for one big beautiful bill that includes all of these tax cuts from the administration. I think it's positive for markets, though, I would imagine, that he is focusing on those tax cuts over some of the immigration policies. There was a question about whether or not the Senate would push him to focus on immigration first, and now we have him saying no to that.
And a lot of economists out there have started to talk and have conversations about how the immigration that could trickle through into the jobs market. And we've seen a very resilient labor market, but any further deterioration on that part, that could be a trouble point for the Fed. So immigration, something to also keep in mind. All your action, markets action ahead. Stay tuned. You're watching Catalysts.
Vanguard's S&P 500 ETF VOO has overtaken State Street's SPY as the biggest ETF in the world, with almost $632 billion in assets after adding about $23 billion so far in 2025, according to Bloomberg. So what does this tell us about where investors are finding opportunities in the ETF space? Here with more, we've got Gavin Fillmore, the Chief Revenue Officer at Tidal Financial Group, joining us now for this week's ETF report brought to you by Invesco QQQ. Great to have you on. So VOO, now the biggest ETF, beating out SPY. And I've had people explain this to me as VOO is better for investors, SPY is better for day traders. Would you agree with that characterization? And for those looking to build wealth and have a little bit more of a passive ETF approach, which is better?
Yeah, I mean, it does come down to basically that. So that's a great point. And it's a real milestone to see these two products at such large AUM levels. But as you suggest, SPY, which has been around the longest, still arguably has the best liquidity in the market, which is good if you're trading more often. It becomes more important. That being said, VOO's fee is lower. So if you're kind of a buy and hold investor, VOO might be more favorable than SPY, but obviously both very healthy products. We can see in that chart, they're both growing. And that's probably a reflection of the top line growth of the ETF market more than anything else.
So you mentioned that lower expense ratio for VOO, so appeals to those fee-conscious consumers. I guess the question for me is, in what case would you want to pay up for that higher expense ratio?
Sure. I mean, active management obviously comes to mind there. You can't get active management for the same price as a passive ETF. And that should be fairly logical, right? It takes dedicated active managers behind the scenes, these PMs that are managing those funds. So paying up for that type of management, certainly in different market environments, or when you're trying to get niche exposure, makes a lot of sense. And then there's other factors, just like the competitive nature of the business itself, driving fees down. So if you're looking for something more unique, more novel, you might expect to pay more for it, but it may have a very good use case in a portfolio.
It's been interesting to see how ETFs have evolved specifically since the pandemic. And I want to talk specifically about the Meet Kevin ETF. The YouTuber closed that ETF after a slew of challenges, including a negative performance and high fees that led to not a lot of popularity in the ETF. But how should investors be finding clarity on both complicated but also potentially just not high return ETF opportunities like something like the Meet Kevin ETF?
Yeah, I mean, to talk about the Meet Kevin ETF for just a quick second, we're actually pretty impressed by what it was able to achieve. Obviously, we don't like to see product closing. That being said, it was very unique, very novel, and it did garner 50 million in AUM rather quickly, and then it sort of fizzled out a little bit, and I think Kevin decided to move on and focus on other things. That being said, it was a good example of innovation in the market. Back to your question with respect to, how should people look at their portfolio, look at performance, look at fees, it comes down to education, obviously knowing what they buy, and reassessing their portfolio on a very regular basis, and making sure that their products are performing as they would like, looking at other alternatives, and sometimes making changes when appropriate.
Let's talk about some of those alternatives, derivative ETFs. They're gaining popularity, but they can be a bit complicated. What types of derivative ETFs exist on the market? And really, who's the buyer here? Because oftentimes they can be volatile, correct?
They can be volatile, or they can be the opposite of volatile. The amazing thing about derivatives is that they allow you to express exposures that can't be done without derivatives. So if you want, for example, protection on the downside, the defined outcome ETFs, which for me were very much a watershed moment in the utilization of derivatives for the ETF market, those are protecting downside and giving people more muted exposures. That became very important during times of stress like COVID and so on. Other products, as you suggest, may focus on other areas like leverage. So one of the first utilizations of derivatives in the ETF market were with leveraged ETFs, because you can't get leverage without derivatives. And those are more for day trading. And then recently, it's really become income that's been a focal point. And I think that started with the zero interest rate environment, but now has just led to further adoption. So, pulling back a little bit, what we've seen is a lot more acceptance of derivatives as tools to can be very, very effective in portfolios.
All right, Gavin, we got to leave it there. Thanks so much for joining us this morning. Appreciate it.
Thanks for having me.
Let's get a check-in on shares of Apple ahead of its plans to launch a new product today that CEO Tim Cook described as the newest member of the family. The stock is down about 0.3% ahead of the event. We're going to have more coverage on that event and the product announcement later this afternoon, but I do want to take a look at the major averages still under pressure here. You got the S&P 500 down about 0.2%. Your tech-heavy Nasdaq down just about 0.3%. And it's interesting seeing some of the big tech names sort of faltering so far this year. You've got 7 of the S&P 500's top 10 contributors this year being non-Mag 7 names, which is interesting in the context of the Mag 7 being responsible for so much of the double-digit rally that we saw in the S&P 500 over the past 2 years. That leadership change-up still happening, especially when you take a look at some of the sectors like financials and energy leading the gains so far today. Well, that's going to do it for me and Allie. Coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Brad Smith will have you here for the next hour, so stay tuned for more.
It's time for Yahoo Finance's Market Minute. Stocks edge lower, the S&P 500 retreating from record highs amid tariff threats from President Trump. Shares of EV maker Nikola tanking after filing for Chapter 11 bankruptcy protection and announcing an auction of its remaining assets. Nikola said it plans to provide services for vehicles in use through March. Etsy sinking after revenue missed Wall Street's expectations, the e-commerce company citing slower consumer spending, competition, and challenging year-over-year comparisons as significant headwinds. And home solar provider SolarEdge shares jumping as a revenue beat and positive free cash flow offsetting a wider than expected loss. The CEO saying SolarEdge expects to maintain positive cash flow for the full year as the company is, quote, just getting started on our turnaround story. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup, we'll break down how investors can be smart with diversification. And how much is Meta CEO Mark Zuckerberg worth? Well, it changes day to day, and we'll explain. Plus, yesterday we tackled tips for first-time home buyers. Today I talked to the chief economist at Realtor.com, and we'll discuss moving out from your starter home to your second home, or perhaps your first family home. All that and much more coming up during this hour. But first, we are 90 minutes into the trading action. Let's take a look at where major averages are. We are lower across the board for the Dow, the S&P 500, and the Nasdaq. Stocks falling amid new tariff threats. The S&P 500 pulling back from a record high. Joining me now, we've got Will McGough, who is the Prime Capital Financial Deputy Chief Investment Officer. Good to have you here with us. You say being smart with diversification is the name of the game. So how are you doing that right now?
Thanks, Brad, for having me on. As one of the top wealth firms in the country, it's great to be on a show dedicated to wealth. Diversification matters more than ever this year. If you think about 2022, 3 and 4, especially in 23, market was up 20%, 24, market was up 20%. I doubt we're going to see another plus 20% trifecta here, 3 in a row. Got a new regime in Washington, D.C., which is going to add a lot of volatility to the markets as well. So I would be very prudent with asset allocation and maintain diversification this year more than ever.
And so with regard to that, where are you kind of broadening out your diversification at this juncture?
Yeah, so I think you have to look at it in equity and fixed income a little bit differently. With regards to an equity portfolio, everybody loves the Mag 7. Mag 7's great exposure. We're recommending to core it up this year, which means kind of get rid of the overweight to those growth companies, look a little bit broader, value bellwether companies that are just going to be a little bit less volatile than the Mag 7. Earnings growth numbers are hit right now, but I would say that we're at peak earnings growth. It's hard for it to exceed the teams that we're in right now. And so I think you're going to see a rotation. So being diversified across core large cap equities and also looking into small caps is a prudent play. For fixed income, we're actually working with our advisors to help educate clients that, you should actually be in some duration bonds. Everybody can go get, 4 or 5% short-term risk-free, but the risk for where rates are going to go is down, not up. So you might as well get the yield and plus any potential capital appreciation from bond prices going up as rates may go down.
Of course, one of the primary components to that Mag 7 trade, NVIDIA, they report earnings next week. What are you going to be listening for to further perhaps cement the themes that have really propelled the Mag 7 to the outperformance that we've seen in the markets?
Right. So they've been delivering on earnings growth. As I just mentioned, they're predominantly driving earnings growth for the S&P. Right now, forward guidance is the name of the game. The markets are a discounting machine, so you have to follow trends. There are massive trends in the market right now, and most companies are reporting good earnings looking backwards, but they're being very cautious with their guidance going forward. And so I think we have to watch NVIDIA here. Are they going to follow this trend of hitting earnings backwards looking, but being cautious forward looking? And that's just kind of the narrative that's creeping into the market right now that, there may just be a little bit of a slowdown in the Mag 7 with regards to earnings growth. You're talking about phenomenal earnings growth to above average earnings growth. But again, that's all taken into consideration with how investors are positioning their portfolios And we think it is prudent to own the Exxon Mobils, Procter Gamble, Walmarts of the world alongside the Mag 7, especially coming off the last 2 years.
It's interesting. And in some of those names that you just mentioned, a little bit more exposure to the everyday consumer. And as we think about that in the macroeconomic backdrop, that takes us to what the Fed is going to be signaling, at least through the meeting minutes once they get published here today. What should we be keeping close tabs on there as to how the Fed and the FOMC is thinking and talking about the consumer right now?
Yeah, so the consumer is the name of the game. I think the stats like the U.S. economy is 70% driven by the consumer. We've got to watch what's going on in Washington, D.C., which is both fiscal and monetary, and now executive with Trump. So the Fed is in a precarious spot. You know, inflation numbers last month ticked up. They've been cutting rates. So you've got a potential distressed consumer coming aboard with tariffs raising prices. Energy markets are still high. Trump wants to bring those down. You've got a potential for, you know, all these government employees that are being laid off or taking the package to leave coming into the unemployment numbers. You've got a lot of the big companies moving more towards AI and less towards workforce. So I think we could see a situation where the narrative starts to change and the Fed is all of a sudden kind of stuck. Could they raise? Did they lower? Did they stay? And it's going to be, I think long term, they're at a higher neutral rate, which is good. We haven't seen that in decades. And so that could bring some, real earnings growth alongside nominal. But again, it's all going to come down to, how efficient is the government, especially Doge, at reducing the deficit, because if you look at every economic indicator through COVID, there was a spike and a return to normalcy. It doesn't really matter what it was, except the U.S. deficit. It spiked and it stayed. And so that's a big problem with regards to what's driving inflation. And so a lot of folks, peers of ours, other asset managers are seeing inflation come down. Again, it's forward-looking with the efforts of Doge, which could give the Fed a little bit of pause, comfort, and staying where they're at right now. Otherwise, if this inflation trend, if they're not successful, inflation ticks up where everybody's forecasting 2 cuts this year, you could see a potential 1 or 2 token increases just to help them combat inflation. But again, it's going to be a wait and see, and it's a fun market out there. It's we don't really have this many macro drivers at play at the same time. We haven't had it in a while, and it just makes it more fun as an investment professional, helping advisors help clients position their portfolios to meet their goals and objectives.
Yeah, well, more fun when you're able to get some gains along the way and navigate what is extreme volatility, as some of our guests have talked about as well. Just lastly, while we have you, Will, as you're really parsing through, and you started to mention this, some of the policy decisions that are coming out of 1600 Pennsylvania Avenue. At what point do you believe that the Fed will have enough of the data and the read-through and the pass-through from some of those policy decisions into the economy in order to then start to clearly make their own decisions and rate policy?
Yeah, so they've been in a tricky situation. Everything they have done to combat inflation was offset by the government with their deficit spending causing inflation. So I think that, again, they're independent bodies as they should be. It's how they were set up in the early 1900s. It's going to obviously factor into their rate decisions. And especially if we can get into a situation where they can have a higher normal rate and then the market, the longer term treasuries tend to plus start to come in like the folks in Washington, D.C. are aggressively trying to do, you could be in a good spot to where, that's why we're advocating for investors to have duration in their portfolio, because, the short term, if crisis happens and we get a recession, some geopolitical shock, the Fed is going to have a put in the market. So they're going to reduce rates. So the curve coming down is the more likely scenario, and you might as well be able to clip the yield and participate if the curve does come down as well by having duration. So again, it's a wait and see with regards to how the data is coming in and what the Fed says with their statements. They did a pretty big rewording last time, so it'll be interesting to see how much of their rewording Fed statements are like super tankers. They don't change much when you're on the open waters. It's hard to change the course direction. So they started to try to turn the wheel with the last meeting, and we'll see if they continue to do so or not.
Right. Will, thanks so much for taking the time here today. Appreciate it.
Thank you.
Let's check in on Meta shares here, extending losses after Tuesday's down day. The stock breaking a 20-session win streak on Tuesday. It closed 2.7% lower. A multi-billion-dollar drop in the bucket hit to co-founder and CEO Mark Zuckerberg's wealth. Mark Zuckerberg is the second richest person alive, according to Bloomberg, worth $252.2 billion, trailing only Elon Musk, who has around $397 billion. You can spot some other familiar names among the top 5. The majority of Zuckerberg's wealth is in Meta, and he holds a 13% stake, or 342.8 million shares worth around $245.6 billion. Rounding out, Zuckerberg's net worth is around $6.6 billion in cash and other assets. But with yesterday's losses, Zuckerberg's net wealth, it fell 2.7%, shedding just over $7 billion in value. And here's some added context. Zuckerberg's wealth has still grown more than 20% so far in 2025. That's a gain of $45 billion. And for comparison, that equates to over 2 times the size of Snap's market cap. Since Zuckerberg's net worth is so closely tied to Meta's performance, his wealth will fluctuate day to day, week by week, and so on. This wealth driver is not atypical among tech founders, CEOs, or heirs to family fortune, as financial growth can largely be tied to the success of one business until an asset diversification strategy is activated and managed across other investments. Coming up, everyone, I speak with the CEO of freelance services marketplace Fiverr about how creatives can utilize AI to grow their businesses. That's next on Wealth. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's talk a little Toll Brothers. Missing first quarter results on the top and bottom line. Total home sales for the quarter also a miss. The company attributes the softer results to impairments and the delay in the sale of an apartment property, saying their core home building operations met expectations in the quarter. Oppenheimer views the results overall as, quote, solid, calling out gross margin as a highlight. Evercore ISI notes the challenging quarter, but also points out gross margins amid challenging conditions. Next up, Capital One is getting an upgrade at Bank of America. The stock raised to buy from neutral with a $235 price target. That represents about 16% upside from Tuesday's close. B of A is positive on the company's merger with Discover Financial Services, saying it could unlock near-term synergies and provide meaningful strategic and operation upside for the company longer term. The analyst says that the combined company could earn mid-teens plus returns on equity, which could lead to multiple expansion. Finally, Supermicro Computer is rising, extending a week-long surge that is seeing the stock fully recover losses after a scathing report accusing the server maker of accounting violations last summer. The rally has been a driver by company report last week, driven by the company report last week, detailing ambitious long-term targets, which is boosting investor sentiment following the accusations. The stock has been on a tear, up more than 80% year to date. While Fiverr shares are pairing earlier gains after beating analyst expectations for revenue in its fourth quarter. The company also introducing new AI tools for freelancers on the platform. Joining me now, we've got Mika Kaufman, who is the founder and CEO of Fiverr. Mika, it's always great to grab some of your time here with you. Just want to get your own take, your own perspective on this most recent quarter and what you're rolling out, especially as you're looking through the broader trend environment for some of the power users that are on Fiverr.
Good morning, Brad, and thanks for having me on the show. So basically, we've opened the market today with the opening bell with our community, which is always a celebration, and we delivered a great quarter, Q4, finishing the year very, very strong and coming up with guidance for the year 2025, a very strong guidance, double-digit growth, high EBITDA margins, rule of 30. We're very content with the results that we're delivering. And alongside with it, we just announced yesterday a major release of a suite of tools, AI tools, that are supposed to provide our sellers with superpowers. We call this the giga economy because we believe that these tools could turn a one person into a production house. And who knows, maybe the first $1 billion business coming out of Fiverr.
And so with that in mind, we're taking a look at that offering, the pricing tiers as well here. What have you noticed within the core user base of Fiverr and the type of services that they skew towards that make this a viable business opportunity long-term for the company?
Sure. So basically, the company in its very fundamental function is providing opportunities for freelancers. This is what we do. And we see how worried they are over AI and its impact on their careers. And what we've introduced is really a new take of how AI could be designed. So instead of AI being exploitive, feeding on everyone's creation and then churning out work that doesn't have any credits or opportunity for gains, what we're doing is we're creating their AI. We create personalized AI that is based on their world of creation, allowing them to enjoy both the credit and the upside, the compensations out of that work. And at the same time, it's actually saving them a lot of time of convincing customers that they're the right people to do it, because customers can play with these models on their own, and building the confidence to work with the actual freelancers. Sometimes the models are so good that they can actually buy the work, but every work comes with the editing power of the talent that stands behind this model. So unlike other AI where you're left alone to deal with the results, here you always have the actual talent to bring you to the finish line to get exactly what you're looking for as a customer.
And for those creators, for those freelancers, how are you seeing them successfully create even more business opportunities, cutting down the amount of time that it takes for them to perhaps respond to business inquiries and even produce and get back to and generate even more clients by the use of AI, and how you're expecting that to grow over the next few years?
So the good news is we've announced yesterday 2 pieces of new technology. One is the creation model. The other is an AI personal assistant. The idea around this, and there's between yesterday and today, there's thousands and thousands of freelancers that already activated this personal assistant. The idea is that what we've noticed over the years is that the first 3 minutes after a customer contacts a freelancer are the most crucial time for conversion. And freelancers also need some time to rest, and sometimes they're just busy. Now they have the assistant taking on customer inquiries, and it does it instantly. And it does it very personally because the personal assistant is entirely based on the world of that specific freelancer. So it knows how to handle the most complex questions, and it's actually being a salesperson for that freelancer, making sure that deals are getting closed. And what we're seeing between yesterday and today is that this is exactly what's happening. Those assistants they don't appear to be like chatbots. They talk in very natural language, so much so that some of our customers weren't sure if they were talking to AI or to an actual person, and they're converting really well. And this is all happening while the freelancer is sleeping or just busy on a different task. So we think that this is going to be a game changer over time. And over time, as the assistant learns how to work with a freelancer, they would also become a business partner, allowing them to get insights into how they can improve their visibility, their business, to get more exposure and more business.
Mika, just lastly, while we have you very briefly here, it's not often that we hear public companies announcing equity programs for some of the power users on their platform. Break down how Fiverr is going about this.
So essentially, I've been wanting to do this for a long time, and I'm super happy that we've got to do it now. The idea is that we're taking the top performing freelancers, the people that are the heart and soul of our community, our movement. And we say that if we shape the future of work together, they should own a piece of it. So essentially, those who are mostly loyal to the marketplace, those who build their career on the marketplace and grow their business over time, we want to give them a piece of the success. And I think that this creates an incredible alignment between the success of the company and their success. Everything is intertwined.
Mika, thanks so much for taking the time here. Good to reconnect with you. Thanks so much.
Thank you for having me.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Let's get a quick check of the markets here, everyone, as we are taking a look at the major averages as we're 2 hours into today's trading session, roughly. Dow Jones Industrial Average right now down by about 0.3%. The Nasdaq Composite, that also in negative territory by 0.1%. Trying to make a little bit of a move higher here, see if we can get back to where we closed at yesterday. It's the climb, and it's still happening right now, but ultimately still in the red. S&P 500 flat, just barely to the downside. There too, seeing a little Miley Cyrus action. It is the climb. We'll see if we can get into positive territory and hold on to those levels throughout the rest of today's trading activity. Let's also just take a brief look at some of the heat maps, see exactly what's under today's trade. We'll start off with some sector activity. Energy leading the pack right now. That's up by about 1.2%. However, bringing up the caboose, you've got materials. That's down by about 1.2%. And that largely on the back in terms of the move that we're seeing as the tariffs have continued to be talked about and the inaction getting all the more closer of that. If we do see those rolled out, of course, steel, aluminum, some of those materials that we're going to be tracking very closely over the coming negotiations on the tough tariff talk. Also here, as we were taking a look at energy, one of the leaders, you've also got healthcare. That is breaking out. Right now, it's up by about 0.9%. And so we'll see how that continues to fare on the day. More decliners, though, than leaders as of right now. Let's check in on the tech-heavy Nasdaq as of right now. This is the Nasdaq 100 that we've got to look for you here at. And NVIDIA right now, you're seeing that higher by about 0.5% early in today's trading session. Tesla, that catching a bit of a bid right now. That's up by about 1.7%. And then additionally, we've been keeping close tabs on Meta. Their eyes were watching Marky Mark and the Funky Bunch, it's down right now here on the day by about 2%. That after we had seen a 20-session win streak snapped on Tuesday to begin this week. So ultimately, looks like we're adding on to some of those declines here during today's session, down by about 2% for Meta. We'll continue to track all those names and much more throughout the rest of the session. Switching gears. Layoffs might be coming for the Federal Housing Administration. Bloomberg reporting the Trump administration plans to lay off nearly half, or 40% of workers at the agency. A spokesperson for the Department of Housing and Urban Development, HUD, which oversees the Federal Housing Administration, denies that about half of the workforce at FHA will be laid off, but they did not confirm or deny whether there would be layoffs. Yahoo Finance's Claire Boston joins me now. Claire, let's back up perhaps for a second here and just start with exactly what the Federal Housing Administration does.
Yeah, that's right, Brad. It's a very fast evolving situation. So the FHA does not directly make mortgages, but what it does is it provides mortgage insurance on loans that go mostly to families who may not otherwise be able to qualify for, that conventional mortgage. It insures more than 7.8 million single family mortgages. So that's a pretty sizable part of the market. Depending on the year, that's maybe 10 to 15% of the overall mortgage market. So they play a really key role in giving access to credit, especially to those maybe like lower income type borrowers.
And so what is that impact on access?
Yeah, so it is a very quickly evolving situation. I'm still talking to people. And the biggest concern that I'm hearing right now is that this could really slow down the process for getting those loans. And more than 80% of FHA borrowers are first-time homebuyers, and proportionately, the FHA serves more Black, Latino, and low-income borrowers than elsewhere. So, potentially we are really talking about an access problem when it comes to accessing mortgages down the line.
Claire, thanks so much for continuing to track this and breaking this down for us. We'll keep close tabs on it as well. U.S. housing starts slowing in January as builders pull back on construction amid fears and growing fears over high mortgage rates, affordability challenges, and unsold homes. New construction fell nearly 10% to an annual rate of 1.37 million homes, falling short of Wall Street's estimates. Here with more on the state of the housing market, we've got Danielle Hale, who is the chief economist at Realtor.com here. Great to have you back on the program. So first, just walk us through some of the dynamic here that we're seeing in new construction.
Yeah, thanks for having me, Brad. So in the new construction market, as you mentioned, there's some uncertainty that builders are experiencing right now, and we see that reflected in the data with that pullback in starts. Now, there are a couple of good things happening in that data. One is that completions ticked higher. So builders seem to be in get it done mode, trying to close out construction projects that are already underway. That will near term boost supply, which will be good for buyers, but will make it a little bit more challenging. Builders will have to compete with each other to get rid of and to sell that inventory. Looking further ahead, as you noted, starts are down. That was pretty much in both single family and multifamily types. But looking at the permit data, which is about what is, even further into the future, we saw that data was roughly flat. So not quite as bad as you might expect, given the concerns that builders have about buyer traffic and tariffs and costs down the road. But they're sort of taking a wait and see approach, getting the permits, holding some optimism for the future, but not quite moving forward with projects, perhaps until they get a little bit more certainty.
And so with that, there is the uncertainty of what the cost could be, because we're already at some of the record high prices. And so now, if we did see even more costs that have to get passed through to potential buyers, how are we essentially running the calculus on how much higher the costs could go for potential buyers as well?
Yeah, I think costs have actually been a challenge for home shoppers in the market. New homes have done a better job of being flexible. So builders have targeted smaller footprint homes to help bring down those costs. But if their costs rise as tariffs go up, or if it's harder for them to find workers to build those homes, they're certainly going to try to pass those costs on to consumers. And with mortgage rates remaining very close to that 7% horizon, it's going to be challenging for them to do so. So I do think that puts builders in a challenging position, and that's why we see some of that hesitation in the starting activity.
Danielle, while we have you, I want to take a quick pivot. On the show yesterday, we discussed best practices for buying your first home. And today, we want to talk about moving out of your starter home and into your next one. Maybe you have a family and you're now shopping around. So talk to us about how your mindset shifts from starter to second home, and perhaps give the folks at home some tips for their shopping journey.
Yeah, absolutely. So I think going from a starter home to a larger home can happen maybe sooner than people expect. There's survey data that shows that often people expect to be in their first home a bit longer than actual sellers indicate they're in their first home. But it's great to be able to make that trade up. It's a bit of a challenging market to try to do that right now, but there are some things that consumers can keep in mind. The first, I would say, is to be aware of what are your non-negotiables. Is the school district the most important thing for you? Are you more interested in size and space or proximity to the office? Whatever your non-negotiables are, figure that out and lock it in up front. It'll make it easier for you to make trade-offs down the road, because we know that consumers have to make trade-offs. The other thing to consider is being willing to buy during the off season. You'll get better pricing. You might sacrifice options. We do see more for sale homes in the peak spring season, but you'll get sellers who are potentially a little bit more flexible if you're buying during the shoulder season, which is typically in the fall. The other thing that you want to do is focus on the things you can control. You cannot control inflation. You cannot control the Fed policy and what's going to happen to mortgage rates, but there are things that you can do to get a better rate for yourself. Those include improving your credit score, lowering your debt to income ratio by either paying down debt or trying to grow your income, focusing on your loan to value ratio, either reducing the price of the home you're looking for or making a larger down payment. And finally, the thing you can do the easiest is shop around among lenders. All of those things can contribute to a lower mortgage rate, regardless of what's happening in the market.
Is there a sweet spot right now for the down payment that people should have saved up?
You know, it's going to be different for everyone. The larger the down payment, the lower your monthly costs. But, I think we see a lot of repeat buyers in the 13% or so range. That's about the average. So that's a good target. Of course, if you've seen some nice price appreciation in your starter home, you might be able to put a larger down payment. And that certainly makes those monthly costs lower going forward, which is a nice help when rates are high.
Excellent, excellent. Danielle, thanks so much for taking the time.
Thanks for having me, Brad.
Certainly. Coming up, $124 trillion in wealth is expected to change hands through 2048. We're talking about the great wealth transfer after the break. $124 trillion. You heard that right. $124 trillion in wealth is expected to change hands through 2048, according to Cerulli Associates. $105 trillion of that is expected to flow to heirs, with $18 trillion going to charity. So with all of that money already flowing from one generation to the next, we want to talk about risk management practices to help people properly protect their wealth. Joining me here in studio, we've got Mary Lago, who is the Chief Wealth Strategist at Ferguson Wellman Capital Management. Great to have you here in studio with us.
Thank you so much for having me, Brad.
Absolutely. So let's talk about this a little bit. The great wealth transfer and how people can set up a holistic approach for both passing on wealth and inheriting wealth.
Exactly. So with all of this wealth in transit, it's important, there are important implications for both the givers and the receiver. And so you want to transition that wealth to happen in a way that maybe benefits not only from the wisdom of the investment knowledge that has helped build these resources, but also incorporates the values of the individuals that will be giving these funds away. For those who will be receiving the wealth, it's important that they get exposure to those concepts, to start with basic things like investing and wise tax strategies. And there's some great tools available to help build that comfort. So one other important point here is that with women living longer and with more women in younger generations being involved, more women are controlling wealth as we look to the future.
Certainly. So how are you advising clients to get started?
Well, in terms of simple steps that individuals can take to start building comfort level at the younger generations, if you have young individual family members who are early in their careers, setting up a Roth IRA is a great opportunity to start build some comfort with investing, as well as having some skin in the game so that they really care what's happening. It also has other benefits such as growing tax-free for a long period of time. Donor advised funds are a great way to engage individuals with your philanthropic values. So that not only, again, has great administration ease and tax benefits, but really helps instill some of those values and transfer some of those discussions around why are you giving and what do you hope the benefits will be. As investment advisors, we're really focused on managing the risk in the investments. And so many higher net worth individuals have the challenge of some embedded gains. They have concentrated positions. And we say in the industry, concentrations build wealth and diversification retains it. But there's this balancing act between can we just position the portfolio in an ideal way, or what would be the tax cost of doing that? And so it's often being done over a period of time.
With that in mind, when you talk about risk is viewed differently among different generations as well. And so when you see and think about some of the sectors that might see more inflows as this great wealth transfer takes place, what are those sectors that are set to benefit the most, perhaps?
Well, more than looking at the sectors, I mean, certainly we look at the younger generations, they're more comfortable with things like technology. They believe and they've seen more of the benefits of those. I guess I think of it more in terms of, I think of it less in terms of which sectors are set to benefit and more what are the ramifications and how can we help equip these generations so that they're going to be prepared and engaging them in the process, also paying attention to the taxes. Right now we have a 40% federal estate tax. So as this wealth transfers without proper planning, that's going to get a 40% haircut, and some states also have a state level estate tax.
Yeah. So all that in mind, as you're thinking about some of the current clients that you're working with and onboarding even new clients at this juncture, what is the number one question that they're asking about how they can just manage this incoming wealth that much better?
It's really about knowledge. How can we help equip the future generation so that they are prepared? And it's using some of those simple places just to get started, maybe bringing them along with you to meetings with your investment advisor, with your CPA, with your attorney. So we encourage individuals not only to build up their own skill sets if you're going to be on the receiving end of some of that wealth, but also to build a team around you. So again, it's that triad of an investment advisor and a CPA and an attorney that can really help guide, because depending on your situation, the risk might look quite different. For someone with a moderate level of wealth, there's maybe moderate risk exposure to taxes, but maybe they have a small business that has concentrated risk. They own a healthcare business, for example. They're not going to want to be building healthcare stocks within the liquid portions of their portfolio. They want to build their liquid wealth in a way that's complementary to other things that they may have in their life. Could be real estate, whatever it is. Pay attention to their particular portfolios, their particular risk, and build around it.
Really solid insights. Mary, thanks so much for taking the time.
Thank you for having me, Brad.
Coming up, Apple is introducing a new low-end smartphone called the iPhone 16e. We break down the announcement with our tech editor after the break. A programming note: on a new episode of Trader Talk, Kenny Polcari sits down with Tom Hayes of Great Hill Capital to discuss how tariff-induced investor panic creates market opportunities, the power of long and short strategies, and navigating volatility in today's dynamic economy.
I think you want to go where earnings growth is accelerating, okay? Right. So last year, earnings were the name of the game for the Mag 7, okay? Right. They had 33% earnings growth, which was double the market. They should get double the multiple. This year, earnings growth is decelerating from 33% last year for the Mag 7 down to 21%. The multiple has not contracted in line with that decelerating in earnings growth. The rest of the market had negative earnings growth the last first 3 quarters of last year. It's now accelerating, and the multiple is half of the Mag 7.
And you can catch Trader Talk with Kenny Polcari every Wednesday, 12 p.m. on Yahoo Finance or wherever you get your podcasts. This Black History Month, we celebrate the power brokers in business, executives, entrepreneurs, and proven change makers who have advanced economy and society. Morgan DeBaun is the founder and CEO of Blavity Inc., a global corporation that has transformed media for Black consumers and businesses. Morgan also serves as an angel investor and advisor to American Airlines, PepsiCo, and the Black Economic Alliance. Joining me now, Morgan DeBaun, Blavity Inc. CEO. Morgan, great to have you on the program with us. You frequently share tips and founders and entrepreneurs on your social media platforms. I see it all the time. You have a lot of folks that are looking to secure funding in a more cash-strapped environment here where VCs are more scrutinous about the money, the capital that they're deploying. How have you seen this change over recent years?
Yeah, thanks, Brad, for having me. I think when we first started 10 years ago, when I was first raising capital, you would always hear those stories of people raising money with an idea on a whiteboard or an idea on a napkin. Those days are over. Early stage VCs are looking for founders and entrepreneurs who have profitable businesses that have product market fit and are looking to basically say, if I give you $1 million, how are you going to give me back $3 to $5 million? So you have to be much further along and really know what you're doing.
With that in mind, you've been able to successfully build up your own media businesses that continue to grow. What are you seeing within the media environment right now as perhaps some of the broader shifts, tectonic shifts that are taking place that smaller players are able to really make sure that they're nimble and make sure that they can also be able to latch onto and go to market that much more quickly?
Yeah, the trends that are really taking off right now is that creators. Creators are now our go-to source for information, for content. You see deals like podcasters getting huge brand deals, huge distribution deals. So old school traditional media is really struggling because they used to be the source of truth. They used to be that clearinghouse of information, but consumers, they don't trust legacy media as much anymore. And so they're looking for people who share their values to give them the information straight to their phones, whether that's on platforms like TikTok or Instagram or even Blue Sky now.
And so with that in mind, from the top down, what does leadership look like to you, especially as you're engaging with a very diverse set of leaders who you're looking to build up within your own organizations and folks who work with you on a daily basis?
The fundamentals of leadership, I don't think have changed regardless of the trends, whether it's AI or, the D&I adjustments. To me, the most important thing is making lasting impact, making sure that our company is staying focused to our values. And when you're really trying to grow into a leader, whether you're early in your career or just starting your first company, you really have to think about what is the change that I want to make? What's the problem that I'm trying to solve? And make sure that you're able to bring people along the journey with you. Because if you really want to change the world, if you really want to build a product at scale for millions of people or billions of people, then it's incredibly important that you're able to bring people with you along the way. You can't do it alone.
There are a lot of people who get into business that just say, hey, I want to make a big buck over time and generate wealth. And there's nothing wrong with generating and growing wealth. Sustaining it over time, even more of a challenge. What would you say is perhaps your top tip for entrepreneurs who are trying to grow and build wealth?
I think a lot of people focus on income. They focus on that top line revenue. They focus on, their personal income if they're a solopreneur. And I think what's more important is to focus on building assets, to focus on what is the true value that you're building. How are you taking the income or the revenue that your business is creating and making sure that it's institutionalized through assets and ownership? Whether you are an employee and you're getting stock in the company that you're working at, or you are a first-time entrepreneur trying to scale your business, making sure that you own the business that you're scaling is really important, because more often than not, I see founders going through rounds of funding and then they wind up with a very small ownership stake and not much power or control in their own company.
That's a very good point. Just lastly, while we have you here, Morgan, as you think about how the landscape is changing for creators, we just had the CEO of Fiverr on earlier telling us about how AI is really going to reinvent the way that creators are able to go to market and own more of their own product. How do you see AI changing the landscape for creators as you work with them, both on the media side and even just more broadly in content creation?
You know, AI is my favorite tool right now. I'm using it so much in my day-to-day work, as well as training our teams. We have a training every week at our own company to train our own team members and employees on how to use it responsibly. I think for creators who are thinking about how do I use this and not be scared of this tool, you should really think about your intellectual property. So what makes you unique? What is your niche? What is the value that you're creating into the world? And then how can you use AI to amplify that, to speed up your workflows, to streamline the amount of content that you're creating and the quality of content that you're creating? You used to have these long processes to build, amazing videos or write incredible scripts, but now the go-to-market should be much faster. So I think we're going to see a lot more creators be prolific and the breadth of content that they create and the speed in which they create it.
Morgan, it's been great to track your ascension in business over the years. Continued success to you, and thanks for joining us here on the program.
Thanks for having me, Brad.
Apple just unveiled its new, more affordable model iPhone called the 16e. Our very own tech editor, Dan Halley, is here to tell you everything you need to know about the new device here and whether or not I need to get it. Dan?
Yeah, Brad, this is basically the I would say next generation of the iPhone SE, which was their more affordable iPhone. They've kind of changed the naming of this, so it's the iPhone 16e, but the general idea behind it stays the same. Rather than the $799 that the iPhone 16 costs, this comes in at $599. It has an updated design from what the old SE had, so you have an edge-to-edge display. At the top, you have a little cutout, so it's kind of like the iPhone 14, but you do get Face ID, you do get Apple Intelligence. You also get the A18 chip, which is the latest chip that's in the 16 and 16 Plus. So you're getting cutting-edge processing power on there. You're getting a good amount of storage as well. The main difference, I would say, is that you're not getting two separate cameras that you would get on the base iPhone 16 or iPhone 16 Plus. You do get a standard camera as well as kind of a 2x telephoto that's worked in there, but it's not going to be that exact two-camera setup. You also get an OLED display, and one of the bigger things to talk about is that this is coming with Apple's C1 chip, which is its first in-house designed cellular modem. So rather than using something from Qualcomm, Apple's using its own design chip. And so what does that mean? Well, it means they don't have to pay royalties or the price to Qualcomm for the type of chip that they're offering. But they also now have more control over the design of the phone itself, as well as how much power it can consume. So you would imagine that including this would fit in with Apple's plans for reportedly a thinner iPhone 17 to come, and then perhaps a foldable iPhone in the future. Adding its own chip in here allows it that much more flexibility. So it could be part of Apple's overall strategy. We just have to see how it performs compared to the Qualcomm-based chips in the past. But better battery life, they say, USB-C, and again, it comes in at $599 compared to that $799 price for the iPhone 16.
All right, Apple shares up right now by about 0.2%. We'll see how they continue to move on this news. Dan, thanks for breaking it down.
Thank you.
That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time.
It's time for Yahoo Finance's Market Minute. Stocks are mixed as investors digest potential tariff threats, but some individual names are on the move. First up, Hims & Hers. Shares jumping after the health platform announced the acquisition of an at-home lab testing company, which will allow the opportunity to offer whole body testing to subscribers. Notably, Hims & Hers is also a heavily shorted stock. Next, Occidental Petroleum. Warren Buffett's favorite energy company popping after it reported a surprise profit growth in the fourth quarter, along with progress towards its debt reduction goals. And shares of computer networking company Arista falling on concerns over Meta concentration. Meta's contribution to sales in the quarter fell to 15%. That's down from 21% in the prior year period. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.